Hello, thanks for joining us to review the Tecnoglass quarterly and fiscal year-end call. We're very excited to share our results with all of you today. We had an excellent year despite all of the challenges around COVID-19. We ended up the year with the highest amount of adjusted EBITDA the company's ever had. We had records, gross profit, operating profit, the best margins we had, the highest cash flow from operations and free cash flow that we've ever had. So all around a very strong year. We'll start with the revenues. Given the fact that we only operated roughly 11 months out of the year at the beginning of a lockdown that was put in place by the Colombian government in March and April, our revenues went down about 12%. But despite that revenue drop, we were able to increase margins by about 500 basis points, and as a result, ended up with higher gross profit, operating profit, and with an adjusted EBITDA of $97.8 million, which is roughly 19% higher than what we had last year. So all in all, a great success. If you look at Q4, revenues started trending up. We had absolute revenue growth year over year, led by the single-family residential segment, which was up for an outstanding 51% against the results from Q4 of 2019. So all in all, the U.S. continued to move into the right direction, performing very strong, led by the single-family residential, which is really associated with everything that is going on from a macro perspective, from a secular perspective. And we expect this to continue being the highest growth segment for the company this year, as well as for years to come. From a profit perspective, gross profit margins ended up at about 37%, which is 500 basis points higher than what we ended up in 2019. A lot of that was related to the automation initiatives that we put in place throughout the year. So we were able to trim headcount, we were able to trim raw material costs, and all in all, it outperformed our expectations to get to the results that we are seeing today. Q4 gross margins were 36%, so much higher than last year for the same reasons as I just mentioned. Operating profit was higher year over year, in line with what we had expected from an SG&A perspective, basically flat from Q4 of 2019. But because of all of the efficiency derived from a higher gross profit margin, we ended up with a much higher adjusted EBITDA, north of 26% as a percentage of revenues. From a cash flow perspective, it was the best cash flow year we've ever had. Cash flow from operations north of $72 million, free cash flow north of $50 million. This has allowed the company to delever its balance sheet. We ended up at a net debt to adjusted EBITDA ratio of 1.6 times, which is significantly lower than what we had just 2 years ago, north of 2.5 times. So we are at a very comfortable level right now. Cash in hand is over $67 million, and we have our untapped revolver, which gives us another $50 million on the syndicated facility that we just refinanced. Speaking of which, we completed the full refinance of our notes that were due in January of 22. We were able to take that out at the end of January 21, extending maturities through 2025 and decreasing our weighted average interest expense by 500 basis points from 7.7% to about 2.5% to 2.7%. So great news there all around. From a balance sheet perspective, we were able to put ourselves in a position to save about $11 million going forward, which are also, as expected, going to flow down to the bottom line. From a backlog perspective, good news as well. After pausing in Q3, given everything that was surrounding the markets and the industry related to COVID, we have now seen a pickup on backlog on a sequential basis, and actually we're able to grow backlog year over year and trending the right way. Is definitely what we are seeing in January and February of this year, much healthier conditions, and we expect that to move in the right direction going forward. So with that, we want to thank you for your attendance here. We're happy with the results. We're looking for 2021 to continue being a solid year. We put out formal guidance to grow revenues to about $415 million, which ends up being a growth of 12% on the higher end of the range. The range is to go from 400 to 450 million, and an adjusted EBITDA guidance from 100 million to 110 million, which at the midpoint of guidance ends up being almost 7.5%. So we're expecting the growth to continue, driven mainly by single-family residential, and we continue to expect margins in line with what you saw at the end of the year, gross margins of mid-30s, which will equate to adjusted EBITDA margins of mid-20s. Thank you so much, and hope to see you soon in our next call. Bye-bye.